Hello everyone and welcome back. In this video I want to talk about software companies. When will software stocks bottom? We have what we call the SaaSpocalypse of 2026, and as you can see, plenty of stocks are going down. If you are remotely being affected by AI, and if you are remotely a software company, your stock is likely down. You are getting punished by the market because AI is bringing you more uncertainty for your business model. But it is not the first time we have such a drawdown in a specific industry. So in this video, I want to talk about the signals that have to be monitored to really understand if we are in the bottom or not. If stocks are rebounding, if this is the absolute bottom, or if this is a fake breakout, a fake rally, a fake bull signal. Well, first of all, let me say that these stocks were not cheap in the past. These stocks were very expensive. So just a simple reversion to the mean back to fair value is causing a 30% haircut, first of all. But now that we already have this haircut, what can we monitor? And this will be very interesting because I believe out of this ecosystem of software companies, you have a lot of opportunities. You have companies that are very safe from AI, and if you can buy them at a pretty reasonable price, you can outperform the market. You can beat the market because you have golden opportunities right now. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I bought some of these stocks that are hated, and we will see. It will be very difficult to catch falling knives if you don't know what you're doing. I can start this video by saying this. Out of all the software companies, only a minority are worth buying. If you want to outperform the market and have a really good performance, you want to invest in winning companies. Companies that will not lose because of AI. First of all, you can already see some companies that are falling behind because of AI. You can see, that's already there, some KPIs, declining margins, declining number of users, declining revenue. Some companies are being affected in a very negative way and they show no sign of recovery. So first of all, don't buy anything, okay? You can only invest in companies that are not in this position. Either they are stable or they are rebounding fast when it comes to the KPIs. You have companies like Salesforce, ServiceNow, Valuation, everything is going up. All the KPIs are going up. You want to invest in these winning companies. First point. Second point, as I told you at the beginning of the video, some of these companies had a very expensive valuation. So you just come back to reality. And as you can see here, Datadog, CrowdStrike, Snowflake, Shopify, Palantir, Adobe, all are down in 2026, 30%. Some of them are down 50%. You can look at Intuit, down massively. Plenty, or Workday, plenty of companies that are down massively. This is a SaaSpocalypse of 2026, but they entered this period a few months ago with a very expensive valuation. So it's just a reversion to the mean, back to fair value, which means it can continue to fall. Stocks that are winning can go from fair value to cheap. We've seen the same phenomenon happen for meta platforms in 2020, late 2021 and 2022. The stock was a little bit expensive. They had many problems at the same time. You had indiscriminate selling, a lot of selling pressures. So the stock went down to fair value and went down to being cheap. And at the end of the cycle, when you had the maximum amount of pessimism and hate, the stock was trading at a free cash flow of 10. Meta platforms could be bought at the time at a price of free cash flow that was ridiculously low. And I am seeing some ridiculously low prices for software companies at the moment. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And I want to tell you about a pattern. I want to talk about Workday that just reported earnings and Salesforce. As I'm recording this video, they just reported earnings because of a simple psychological thing from Wall Street. Let's say this is your stock price that decline, and that is rebounding, okay? You clicked on this video, you want to see how to spot the bottom. First of all, I already talked about valuation. You want to catch falling knives when the valuation is low, when the valuation is cheap. Don't touch companies that are expensive at the moment. Don't touch companies that are down 50% and still expensive. This is a simple way to lose a lot of money rapidly. Now I want to talk about earnings. For example, in the past couple of months, we had some worries about AI, and let's say the company reported earnings, I don't know, at this point, this point, and this point. 4 earnings reports, okay, and then the recovery. Over the past few months, what we have seen from this industry, this software industry, is people are negative. So the company reports earnings and the report is negative, viewed negatively by the market. I'm putting a red cross, meaning, okay, many uncertainties, more worries in the future. The CEO is confident, but not too much. The KPIs are not reaccelerating. The revenue is not reaccelerating. So just in case, sell first, ask questions later, and the stock falls. 3 months later, the results were also negative. So the same questions, we don't have the good answers. We have many uncertainties. Stock is getting killed. Again, a third earnings report in a row. Bad, negative, a lot of hate. People start to really doubt the business model. The CEO shouts. The CEO cries publicly. But the CEO is not saving the company and the stock price. So people sell first. You have indiscriminate selling without looking really at the numbers from Wall Street. And then this will be the turnaround play. For some of the companies that are down to being cheap, there will be a moment, an earnings report, when the earnings are still viewed negatively, the KPIs are still not rebounding, the metrics are still not great, but the stock will go up. Because all the investors that wanted to sell have already sold. There is no additional selling pressure because everybody has sold. All the people that were hesitant are gone. And you know how the stock market works. It's about supply and demand. So if you don't have any sellers, you have either holders or buyers. So people will buy the dip. And you will have more people that will buy the dip here, despite a low quality earnings report. Okay? This is the moment a stock bottoms. 1, cheap valuation. Very important to have cheap valuation. 2, the KPIs are not great. The tone of the management team is not changing. They might be delightful, very optimistic. But they were optimistic in the past. So nothing has changed. But suddenly, stocks go up. And stocks go up maybe for another reason that can be new about what will be the future of the company. Maybe the CEO will talk about new KPIs in the future, potential reacceleration, but not now. It will be in 6 months, future projects. And maybe you will see some traction here. Okay? The KPIs will still not be great. How to know if this is a false bottom? How to know if this is a real bottom? It will all depend on the next earnings report. okay? So I'm putting a cross that is orange. So results are still bad, but less bad, okay? Very important to confirm this. You have this double negative reports here. Very, very important. And then you will have another report that will confirm the trend. And then the stock will skyrocket up. This is how it has happened for Meta Platforms. For Meta Platforms in 2022, the stock got crushed back to $88, if my memory is correct. And then they announced a horrible earnings report. And they announced massive layoffs. You wait a couple of weeks, they announced again massive layoffs. They have a public letter from the CEO, Mark Zuckerberg, saying, next year will be the year of efficiency. Trust us. We will change. And the report was a little bit better, and then a little bit better, and then a little bit better. This was the confirmation that it was the bottom. And for some companies in the software industry, maybe we are in this stage. Workday is a good example. Workday is a company that is hated at the moment. The stock is down to $130, back to where we were at the bottom of 2022, back to where we were in 2020, back to where we were at the end of 2018. So a lot of hate. And they recently reported earnings. The earnings were not good. It was okay, a little bit bad, nothing really surprising, but look at the stock price. It opened at minus 13%. Like the day they report earnings, the stock is down 13%, but then the stock recovered, and it finished the day positive. Because you don't have sellers anymore. Everybody that wanted to get out, got out. So maybe it's a new trend. Now this stock price holds. Let's see what we have. I would not be surprised if this is the bottom from Workday, for example. First, confirmation step. The second confirmation step I want to see is the next report. In the next 3 months, do you start to see a little bit of an improvement? And also I want to talk about valuation for Workday. This is your forward PE ratio for Workday. In COVID, it was at 40, and then 2021, it was at 80. So very expensive valuation. And this is what you had for the company. In 2024, the forward PE ratio was 42. So expensive. This is why I started this video saying be careful of valuation. And then it dropped. In 2025, it dropped to a forward PE ratio of 25. And now we dropped a lot from a forward PE ratio of 25 to 12. Now we are cheap for Workday. Everybody hates this stock. Nobody believes in their new strategy. The stock is getting demolished at the moment. This is the good setup for a bottom. I'm not telling you it will happen, but every time it happens, you have this pattern, okay? Check the false positives, but this is what you have. Another example I have for you is Salesforce. Salesforce reported earnings a few days ago as I'm recording this video. The earnings report was okay, nothing terrific. They had an acquisition, you have some adjustments. The growth rate was okay, an organic growth rate of 7%. The margins were decent, but nothing surprisingly good. The CEO was shouting a lot, but the results were not reaccelerating. The metrics were not reaccelerating, so it was an okay report. And that was justified. I mean, the business is not reaccelerating. So we are at this stage of a bottom, and the stock finished up. And now it seems like the stock doesn't want to go down. You have a bad earnings report. Bad meaning not great, not reaccelerating. So we are still on a downtrend. And the stock is not going down anymore. In aftermarket, when Salesforce reported earnings, Salesforce was down -3, -4, -5%. And then it finished the day up. And now the day after this, it's down. Well, it's just noise. You want this next confirmation point. The step 2, the yellow earnings report. when metrics start to improve a little bit, when you see the light at the end of the tunnel. If you don't have this improving metrics here, this is not the bottom, or very unlikely. You want to see some signs of relief. This is how you can see how software stock can bottom. You have this exact template every time you have hate in the market, every time you have an industry filled with negative biases, pessimism. This is what happens. Bad, 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 and then bad, but it bottoms. Less bad, less bad, less bad, and then it rebounds. So we will see. For all these companies, I'm monitoring almost everything actually. All the metrics for all of them and checking all of them. And you have to be extremely careful who you choose, because some of these companies are still expensive. Some of these companies are still not profitable. Some of these companies are still burning cash. The management is not so great. You want to be really careful, okay? And one of the disgustingly cheap company I have in this sector is Adobe. Adobe entered this drawdown with a forward P ratio of what? 25. And then it dropped, and now you have the forward P ratio of 11. We will see. We will see if this is the local bottom, but now we are at an extremely cheap level. Look at the valuation for Adobe. We have the lowest valuation we've seen for the past 10 or 15 years. So yeah, that's a lot. And for the next results, the next earnings reports, like the next one or the two next one, like the second one or the third one, you want to see this pattern, to see if metrics are reaccelerating and getting better over time. And this is how you can spot when to buy software stocks and when you can spot the bottom. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.